Good evening. Welcome, alumni and friends, to the future of money, a subject that's far-reaching in its implications for all of us. Thank you for joining us. I'm Susan Joseph, Executive Director of the FinTech at Cornell Initiative at the Cornell S.C. Johnson College of Business, and I'm your discussion moderator. Today we'll hear how innovative digital currencies and financial technology platforms will impact society from upstate and downstate experts from Cornell's S.C. Johnson College of Business, Cornell Tech, and Cornell Law School, a great cross-disciplinary group. First, we want to do some housekeeping. Since I'm a lawyer, I have to make the disclaimer that says I'm not giving legal advice and I'm not your lawyer. Also, none of our participants are going to be giving investment, tax, or other similar advice. The format for today is that each panelist will present how they're thinking about digital currency and financial technology platforms from their area of expertise. We'll transition to a panel discussion based on some pre-submitted questions, and then we'll take some questions live from this chat. A note to our panelists. For our audience's sake, if you use jargon or an abbreviation without defining it, I will likely interrupt you and ask you to define the term. Okie doke, with that, let's go, and let's talk about the future of money. So what has brought us to the point where the conversation in many countries and across enterprise and consumers alike is about the future of money? We're seeing different conversations across the globe. In Europe, there is a trend to open banking supported by legislation. In the European context, open banking means that banks and other financial institutions open up data for regulated providers to access, use, and share, which brings more innovation, competition, and benefit to users and providers alike. In Asia, for example, we see Singapore seeking to take the lead with regard to digital currencies with its government support. Contrast this with China's work on its own central bank digital currencies and its on-again, off-again relationship with Bitcoin and other cryptocurrencies, which are currently banned. In emerging markets, we see experiments with digital currencies, central bank digital currencies, and the granddaddy of mobile money, M-Pesa. M-Pesa is described as a virtual banking system that provides transaction services through a SIM card. Once the SIM card's been inserted into the card slot of the mobile device, users make payments, transfer money to vendors and family members with SMS messages. In the USA, it's a little bit different. We have a financial infrastructure and rules supporting it based on paper or analog types of transactions and third parties who we trust to execute our system. Many would say the financial crisis in 2008-2009 taught us a really hard lesson about the risks and stresses in our financial infrastructure, and conversations about that infrastructure being overhauled continue today. In general, we have not embraced open data or digital currencies as of yet, but these areas of infrastructure are actively being debated. You need only to look at the news to see the discussions and governments speaking about things like central bank digital currency, digital assets, differing policy, technology, and regulatory approaches regarding centralized versus decentralized systems, and how to create more financial inclusion. In fact, the New York mayor-elect stated today that he will take his first 3 months' salary in Bitcoin and move to create New York as a center for digital assets, which sparked a friendly Twitter competition from the Miami mayor, who embraced the digital asset industry earlier and is actively wooing it. With this level of activity, it's an understatement to say that this is a hot area, ranging from whether the use of cash will disappear, the potential surveillance aspects of private and/or government-designed digital currencies, what types of anonymity should be built in, types of identities needed to engage with digital monies, who will be able to access the digital monies, how monetary policies will be set and administered, what taxation will look like, and the education needed to engage with digital monies, and how will the existing financial world mesh with this or not. Regulators are also quite active in this global conversation. Last week we had guidance from a group called the Financial Action Task Force, known as FATF, which is a watchdog for money laundering. They give guidance. While it's not something that is a law, it's something that is taken very seriously. This week, we had a report discussing stablecoins issued by the President's Working Group on Financial Markets, joined by the Federal Deposit Insurance Company and the Office of the Comptroller of Currency. And in other words, all the U.S. regulators got together to issue recommendations for the way stablecoins should be treated going forward. I am, of course, part of this discussion and will define my term stablecoins for you. They define stablecoins as digital assets designed to maintain a stable value relative to the US dollar and are used to facilitate trading of other digital assets, but could widely be used in the future for business and consumer payments. Thinking about this potential transformation and resulting issues are only one aspect. The devil will be in the build, the regulation, and the implementation details. Input from those who are hands dirty building this system are encouraged and desired. And the technology and economic build must include legal considerations as well. In today's discussion, I am extremely interested in Eswar, James, John, and Lourdes, your perspectives and experience here, and will offer my own as well. So now let's turn to our truly amazing panel of Cornell professors and alum. I will ask each of you, starting with Eswar, to give a quick self-introduction. Tell us how you became interested in the subject, the future of money, and the one thing that you find the most interesting about it. So Eswar, you're up first.
Thank you, Susan. I'm a professor in the Dyson School in the S.C. Johnson College of Business at Cornell. I usually work in areas related to international trade and finance, but about 3 or 4 years ago, many of the central bankers I tend to hang out with started asking me questions about digital currency, so I decided to read up on it. Found there wasn't much to read up on, so I started writing on my own. Sadly, about 2 years ago, I made the decision that rather than investing in Bitcoin, I was going to write a book about digital currencies. So right now I have a book. I don't own any Bitcoin, but I'm hoping to do a lot of research on the interesting revolution that I think Bitcoin has set off. And one of the aspects of that revolution is, I think, going to be the death of cash. But there is a lot of exciting change coming as well.
Thank you, Eswar. Okay, now James, you're up next.
I'm a law professor. I'm based out of Cornell Tech in New York City, where I work on internet and technology law. And my interest in this actually goes back about 15 years when I was studying law in virtual worlds and online games like World of Warcraft. And one of the issues that kept coming up there was virtual property. What kind of rights did people have over their entirely digital animated swords in these games? And being interested in these purely virtual assets really made me pick it up and pay attention when blockchain-based assets started getting big. So I've been interested in how we conceptualize property rights over these new things that really don't exist any place you can put your finger on and point to.
Great. John?
Thank you, Susan. My name is John Wu. I am president of Ava Labs. Ava Labs is the software and services team behind one of the top blockchains, Avalanche. Avalanche is similar to Ethereum with different features of more speed, probably more scale, and instant finality. The interesting thing about Ava Labs and what everyone on this panel and also in the audience will be very interested is that it is a Cornell company, and Cornell actually owns a percentage of Ava Labs. A well-known professor in the computer science department, Eamon Gunseer, had created his own consensus protocol after having guided so many students in the computer science department into their own blockchain careers. And then we as a team have gone out there and become probably one of the largest blockchain companies out there. The team's about 120, and I would say 35 are computer scientists, Cornell alumni. I'm also a Cornell alumni. I got into the space first as an investor. Before I was an operator and running a company, I was a tech investor right out of Cornell at some well-known funds. I've always been interested in the emerging technology, especially in fintech. In about 2014, I first got into it as an investor simply because I thought it was misunderstood. It was only really Bitcoin back then. I myself couldn't really understand how to value it. I was looking at Bitcoin more like a security. What is the utility? How do I do a DCF, discounted cash flow on this? And unfortunately, I couldn't figure it out. So I was myself very skeptical. Something clicked, and I realized, stop looking this as a company with utility, at least on Bitcoin, and look at it as more of a currency or commodity. So I looked at it from a pure incremental supply and demand perspective, because there's a curve on how many Bitcoin are mined a year, and you can kind of extrapolate. And then on the demand side, you can look at the number of addresses and wallets that were being created. With some assumptions, one thing was very clear. The incremental demand was far greater than the incremental supply. So therefore, at roughly about $300 or $400, it was clear to me that it was going higher. I had no idea that today, 7-8 years later, would be in $60,000, $65,000. So I was lucky there. And then the next aha moment was actually about utility. In 2017, there was a massive ICO boom. And I was fascinated how these companies were able to raise money in such an efficient manner in a global crowdfund. And a lot, we're talking about tens of billions of dollars was raised. So I'm thinking that's hundreds of millions of dollars that's not going to the investment bank that I'm used to dealing with, like Goldman Sachs. And this is quite disruptive. And this is kind of the first use case I saw. The problem was a lot of the raises in the US were effectively illegal because they went around the Securities Acts of 1933 and 34, and the industry had to recalibrate. But that was the first instinct that I saw that, wow, there is beginning to be utility for this. And that means a whole new level of disruption, possibly for the entire financial infrastructure that is currently built. And that's when I got even more excited about this space and became an operator.
Thanks, John. And for those of you who don't know what ICO is, it stands for Initial Coin Offering, which is John correctly defined as a type of crowdfunding. Okay, Lourdes, last but not least, you are up.
My name is Lourdes Casanova. I'm a senior lecturer and also director, Gail and Roberto Cañizares, director of the Emerging Markets Institute at the College of Business. I got as I always have thought about emerging markets, I was obviously interested in currencies because currencies from emerging markets in general are very volatile. And this causes when the value of the currency collapses, like happened in Argentina in 2002, what is happening right now in Brazil that has gone from 1.4 to now 5.2. How can you plan anything as a country, as a company, and also this causes this increases the inequality in those countries. Because yes, those at the top can manage this volatility, exchanging with dollars very early, but those at the very bottom, they can't, and their salaries collapse the value of their salaries. So that's why I was in favor of dollarization. Dollarization has not worked. And yes, now I look very carefully how these markets are launching this Bitcoin, like El Salvador, and I'll talk more about it later. They use Bitcoin and also, for instance, China, the currency, digital currency, or now Nigeria as well. So these are experiments to solve a serious problem in emerging markets.
Thank you, Lourdes. And I see that we have some questions coming in. We are going to handle the questions at the end of the presentation. We've reserved some time for that, so don't think we're not going. We'll get to as many as we can. First topic, let's have an overview of the future of money. Eswar, I know you recently authored a book entitled The Future of Money. I'm giving it a shameless plug because I read it in preparation for this particular webinar, and I highly recommend it. We're experiencing a time of great disruption, in part accelerated by COVID. It could include the demise of physical cash. So how do we think about the future of money? Can you give us an overview and what the implications are for institutions, governments, and users of the money, consumers? Should we be concerned about privacy, digital reach, accountability, and instability as we move in this direction? Not a lot to answer. Go ahead.
Thank you, Susan, for that introduction and also for the plug for my book, Every Little Bit Helps. Financial innovation is nothing new, and innovation in the form of money, of course, has taken place over the centuries, from the very creation of money to the evolution into paper currency in China back in the 7th century, and then the evolution of fiat currency, unbacked by anything, in China again in the 13th century. And then the creation of central banks basically settled the competition between private and fiat, that is government-issued currencies, very decisively in favor of government-backed money. But now in the long arc of history, we are coming back to competition between private and fiat currencies. And as an economist, of course, competition is a good thing, so long as there are effective guardrails. Now, this new wave of competition was set off even before Bitcoin came along the way through mobile payment technologies that Susan referred to in initial remarks that allowed for transactions to be completed even without using central bank money. Bitcoin, which was perfectly timed at a time when trust in governments and traditional financial institutions was at a very low ebb, right after the financial crisis, certainly got a lot of traction. But Bitcoin was supposed to be a medium of exchange that would allow for transactions to be completed using only people's digital identities rather than their real identities, and without having to rely on central bank money or a traditional financial institution. In that purpose, Bitcoin has failed. It's a very volatile medium of exchange, so it doesn't work very effectively in that function. The network cannot handle a large volume of transactions. It takes a while to process and validate transactions. So curiously, while it has failed in its basic purpose, Bitcoin has instead become a speculative financial asset. And to an economist, again, one fundamental question, in addition to demand and supply, which John spoke about, is what is the intrinsic value of an asset? Just the fact that there is scarcity, you would think, is not going to be enough to sustain value. Investors' faith, of course, is certainly enough, and that's what seems to be carrying Bitcoin along. But I think the real legacy of Bitcoin is going to be the technology, and I know John is going to talk more about this. The blockchain technology, I think, really has transformative potential in the fields of finance, but even in other aspects of our economic day-to-day transactions, such as buying a house, buying a car, which could be done much more easily using blockchain-based technologies that did not require the traditional trusted financial intermediaries. The other big change that is coming in the context of money, of course, is central banks getting into the game by issuing digital versions of their own fiat currencies. Now, there are a couple of central banks that have already issued their digital currencies nationwide. Both Nigeria and the Bahamas have done so. There are three major economies, China, Japan, and Sweden, that have initiated trials of their CBDCs, central bank digital currencies. Many others have already indicated plans to do so, and the Fed will be releasing a report about its own view about the digital dollar fairly soon. Why are central banks doing this? At one level, it is to broaden financial inclusion. If the government can provide a low-cost digital payment system that everybody has easy access to, that certainly brings more people into the financial system. There are other countries like Sweden where the private sector is doing a perfectly good job of providing digital payments that are easily accessible. The same is true for China. But in these countries, there is a sense that leaving the entire payments infrastructure in the hands of the private sector may leave it open to technological vulnerabilities of confidence crises and so on. So you can think about a CBDC as essentially a backstop. But a CBDC has many other advantages. It brings economic activity out of the shadows. When you can't transact with cash, it's harder to evade taxes by disguising economic activity in the shadows. So it could be good in terms of tax revenues. It could reduce the use of central bank issued money for illicit purposes, both within and across national borders. So I think CBDCs are coming, and certainly they can have a lot of advantages, but I think every government is going to have to deal with some very complicated issues that go beyond the economic and technocratic ones. Because there is a question we have to ask ourselves as societies. Do we really want to live in a world where ultimately anytime one of us buys each other a cup of coffee or a meal, either a private payment provider or the government is going to know about it? What are the risks for the commercial banking system, which in modern economies is responsible for creating most money, if you have central banks starting to enter payments as well? So I think governments and regulatory agencies will have to strike a very difficult but important balance between making sure that they don't squelch private sector innovation, while at the same time setting in place regulatory guardrails that allow these innovations to generate all the benefits that they can for humanity and for society. So at one level, I think we are destined for a much better future with digital payments, with cash perhaps disappearing organically over time. But there are also prospects of a dystopian future, and we need to make sure that using technological designs, we can actually get around those risks without denying ourselves many of the benefits of the new technologies.
Thank you, Eswar. A lot to think about. All right, James, you're on for the regulatory environment, something that is incredibly important and interwoven into anything that will happen regarding financial markets in the future. What's your view with regard to regulation in the financial system in general as it moves forward, and especially with regard to emerging technologies? And I also note that you were author on a paper issued last year describing central bank digital currencies and design choices. So can you comment on some areas to consider?
Sure. I think there are really two broad areas of regulatory oversight of digital property and payments that are worth thinking about. The first set is what we think of when we think of financial regulation. And this is about what prevents there from being bank runs or systemic financial panics, the kind of things that went wrong in 2008. So this is regulation to ensure that important intermediaries have enough assets, that they structure their affairs in a way that's not going to lead to the sudden collapse of other parts of the system. It also involves oversight to make sure that payments aren't being used for money laundering. These are things that regulators can be very concerned about. Now, it's quite possible that some digital systems will be structured in ways that make it easier to have confidence that these things won't go wrong, that when you have a closed system that has better centralized record keeping, you may have better sense from the regulators that they know where the money is flowing and that it's not being used in ways that could cause systemic risks. On the other hand, to the extent you have an environment like we have today, where you have enormous investments in various blockchain assets that are rising dramatically in size, things that were very small a few years ago are now fairly significant compared to the size of the financial markets. And so regulators are quite appropriately looking at them to ask, what do we need to do to make sure they don't pull the rug out from underneath us? The other important category of regulation to think about, and it's something people often don't think about when they use the word regulation, is all of the retail garden variety laws that deal with digital property and assets to make them usable by people and businesses in their day-to-day life. So, for example, when you deposit money at the bank, if somebody walks in and points a gun at the teller and walks up with a bag of cash, then they haven't taken your money. You're still fully entitled to get it back. If somebody forges your name on a check and the bank pays it over to somebody else, and that wasn't a check that you wrote, you're entitled to your money back. And we have rules about how we trace assets in cases of fraud, and we're going to have to make sure that those rules still apply to the systems we use. We don't want to go to a future where if somebody holds you up at gunpoint and takes your digital key that you use to sign your digital assets, that you're completely out of luck. That's not a banking system that I think a lot of people will be very happy to use or would feel great about trusting. And one place that happens a lot is that businesses that take payments and deal in things, they do a lot of this stuff on credit, and their creditors want to know that in case the owners of the business have trouble, that they can get at the assets they've loaned against. An enormous system of secured credit in the US and everywhere else around the world that really depends upon being able to know where the assets of a business are so those creditors can get at them. We have similar questions around garnishment of wages for child support. We want to trace assets for tax purposes. There are a whole lot of places in which the legal system plugs into the financial system that we use for storing assets and for sending them to other people. And it's helpful to think about what the interface between these new assets and the legal system will be. There's going to have to be an interface like that as long as we have a legal system. And really the question is, how do we facilitate its ability to do its job in protecting people and protecting their assets? And that's a question that involves very complicated, sensitive design. Like, one of the things I really find fascinating about blockchains is that people talk about this ledger idea, and it's like the kind of record of transactions that people make and they file in property records. Well, that system is many hundreds of years old, that there are paper books people invented, and they file real estate transactions, other kinds of transactions, and write them down in property records. And those records and the rules of governing them have been worked out by lawyers over centuries. And they didn't just make things up to be complicated. They solved a lot of very real problems of fraud and mistake and accident. And the systems are robust enough against those. And so there's a lot to be learned in making the new technological systems and the legal rules governing them similarly robust.
That's great. Okay, James, thank you. And now, John, we're going to talk about enterprise use of blockchain. You're on the front lines of delivering digital asset services. You are what I would call the hands dirty guy. So how does all the newer digital finance work from a practitioner's perspective? What are some examples of the newer digital financial products? What do people need to do to access them? What do they need to understand? Are there safeguards? Is there education, etc.? Go, your turn.
That's a lot. That's a lot there, but thank you, Susan. To answer some of the use cases that are now popping up, and there really is now utility in crypto and blockchain. It's good to understand some of the benefits. And one of the benefits is that there's this instant finality, especially with this third generation of blockchains like Avalanche, where settlement and payment are instant. And when you have that, what happens is you take a lot of trapped capital that exists in the system right now, whether it's sitting in escrow or buying a stock on the New York Stock Exchange. It takes 2 days before that stock is actually settled. Suddenly, you are increasing the velocity of money because that trapped capital is now allowed to move. So as an investor, in theory, your IRR will go a lot higher because your money is no longer trapped waiting for something to settle, and payment and settlement are so far apart. I mean, and this is not just on the enterprise level. If you look at even how you pay for merchants on credit with credit cards, sometimes it takes some merchants over 30 days before they receive their money from the bank. If we're getting to the point where a lot of the blockchain technology now, with this new generation of blockchains, are actually good enough that settlement really is payment. Think about how much velocity of money could be increased and how much trapped capital can be put out there in the world. In fact, we've been in deflationary world for 30 years. Maybe blockchain is the answer to increase inflation because the velocity of money will increase. And on top of that, another benefit is completely rethinking how businesses and how the current financial system works. Right now, we pretty much have a trust environment. We trust at JP Morgan, their servers and everything who tracks our money is actually good and not get hacked. The concept of a distributed system where it's like a virtual machine where everyone gets a piece of that storage and also has transparency to the data and is part of validating, securing each transaction, allows for a system where it's more P2P. So there's an entire ecosystem now of decentralized finance where the same services and products you see in the traditional finance system, like lending, borrowing, as well as swapping assets, are now done in a very P2P manner. It's small, it's only 250 billion ecosystem, but it's growing and it's growing very quickly. The benefits of being a P2P system where lenders and borrowers are individuals and they have more trust in the code than in an entity is that you take out these middlemen. And if you take out these middlemen, basically each middleman sometimes is just extracting some of their Schumpeterian rents and taking out some of the reward that you would get in your yield, so to speak. And then therefore in the traditional financial system, you have a different product. You have a lower yielding, when you put money into a bank, you have a lower yielding product, but you feel a lot safer. There's insurance and there's all these intermediaries that make sure your money will come to you at the end of the day. In the decentralized finance P2P system, that small $250 billion ecosystem I talked about,
John, for one second.
Without knowing it.
John, for 1 second, can you just define P2P? Because we have some
person
questions.
Person to person, effectively one-to-one, P2P. Yeah. So in that P2P environment, there are no intermediaries. So in theory, a lot of that yield is no longer taken out by each party. And therefore, you can get a higher yielding product simply because of supply and demand. If I'm willing to loan at a certain rate and Susan's willing to borrow at that same rate, it can just be done. Whereas, in a traditional system, you rely on the bank as an intermediary to determine and take their little cut. The insurance takes their little cut, and every other regulator in between takes their little cut. But there's more risk. with reward, there comes risk. Now you have new types of risk, protocol risk, which is the technology risk, but you also have risk that, like I think James can talk about, that how do you define this? Is this legal? And it may not be in the eyes of certain people, but in other people, it's equality, and it should be legal. So there's a lot of new business models that are popping up because of a P2P environment in a powerful blockchain. That's also fascinating and interesting.
Thank you, John. And I have to say that your presentation spurred the most questions from our audience, which we will get to later. Lourdes, of course, last but absolutely not least, because emerging markets is a really exciting place for the future of finance. Not the least of which is that there may not have been strong infrastructure in many of these countries to begin with. So how are these countries looking at the future of finance, and do they have perhaps maybe an advantage if they didn't have existing financial structures? Are they more nimble in the ability to create these systems, and are they looking at them to provide inclusion?
Thank you, Susan. So first of all, some call it the original sin. So emerging markets have currencies that have very little value or none internationally. So that's the first thing. And everybody in any emerging market will tell you that, okay, the oil is transacted in dollars. The value of the dollar is de facto gold standard. So then you want to find ways to avoid these tremendous collapses of the economy that, as I said before, what they cause is a tremendous increase in poverty. So Argentina, even today, 20 years later, has not recovered from the 2002 devaluation of the currency. But it's not Argentina, it's, as I said, most emerging markets. Most of the population in the world don't have a currency that can be used internationally for international trade, and that causes mainly very much poverty increases. Second, as you are saying, there is the banks in emerging markets are not interested in bancarization. Even bancarization programs that were very important in Brazil, then in India, fail because banks at the end of the day become again expensive, credit cards are expensive. So it's not a wonder that in emerging markets, the population is asking for something different, and they are early adopters. As you mentioned, M-Pesa is now 15 years old. If M-Pesa was not as globalized as one would have expected, gave everybody the feeling we can do it, we can work in a different way. And also this linked with the expansion of cheap smartphones everywhere. From India to Africa, you have almost everybody, for sure every family in the world, I would say, has a smartphone and allows these transactions. So then again, so the search for alternatives has made populations in emerging markets more willing to experiment first with mobile payments, now early adopters of centralized central bank digital currencies and Bitcoin. But strangely enough, El Salvador launched the Bitcoin the year that was celebrating the 20-year anniversary of the dollarization of the economy. So guess what? The dollar also, and I was in favor of dollarization at that time, the dollar didn't work for El Salvador, is not working for Panama. Poverty is very high in both countries. And in Ecuador, another example of a dollarized economy is not working. So no wonder that El Salvador, yes, initially there were demonstrations, but now, while only 29% of the population had a bank account, about 46% have downloaded the digital wallet and are using it in daily transactions. And also, El Salvador receives 400 million in remittances. So now they are going to allow that the remittances can come through Bitcoin. And again, as James was saying, eliminating all these intermediaries, all these big players of remittances that still have so much power. So that's the idea. So how is it possible? One, the desire for a better currency that is so crucial for the economies in the world, number one. Second, the adoption of technology. The example of M-Pesa and many other examples in emerging markets, population are early adopters, believe it or not, or new technologies, the smartphones that make it possible to move beyond M-Pesa. M-Pesa was for 2Gs. And then looking for a decoupling from the dollar that is not that beneficial for emerging markets. So what we can see long term of many of these economies is saying this dependence from the dollar does not help Nigeria, does not help other countries. So we need to find alternatives.
Thank you, Lourdes. Okay, now we are going to move to the next part of our program, which will do maybe 10 or 15 minutes worth of questions that we've pre-received questions. We've also been receiving questions. Feel free to put them in the chat, and if we haven't answered them already, we'll try and get to them. So the first question that we got was, what's the impact to the financial system and society of moving away from physical cash? What advantages and disadvantages do digital currencies have for retail, institutions, and regulators? So John and Eswar, I know that you wanted to take this question, so go ahead.
Maybe I'll let Eswar go first.
Sure.
Please.
So these digital currencies are trying to serve a purpose that is a very fundamental need, I think, in many economies, especially developing economies, which is access to low-cost digital payment systems. So even in a country like the US, you can use Apple Pay using your phone, but you need to have it linked to a bank account or a credit card, and about 5% of the adult population in the US is still unbanked or underbanked. So I think the notion of providing easy access to these payment systems is really attractive for both consumers and even for businesses. Think of, the store vendor on a street side in Mumbai or Delhi. That store owner has to deal with the hassles of maintaining cash. There are concerns about loss, theft, and maintaining records, all of which becomes much easier if you use a digital payment system. The other important area in which digital payments can really make a difference is in terms of international payments, which are inherently complicated because you have multiple currencies at play. But those payments tend to be very expensive, slow, very difficult to track in real time. So if you think about the benefits that can be gained there using, say, blockchain technologies that could allow for more efficient cross-border payments, you could then think about importers and exporters benefiting from those gains. In addition, economic remittances sent by migrants back to their home countries, especially the developing countries that are relatively poor and rely on these remittances, those would all become a lot quicker and cheaper. So I think these currencies are trying to fill the gap in terms of a real need that is out there for more efficient payments. What is the most efficient way to do it? Whether it is through stable coins, which is a possibility, although it creates certain risks, or through decentralized cryptocurrencies, which doesn't really seem like the solution, or ultimately through central bank digital currencies. I think that is the question we're confronting right now.
Thank you, Eswar. John, do you want to comment?
I think Professor Eswar captured a lot of that. And I think I'll build off of the last part of what he said, which effectively there's three types of digital currencies. There's the central bank digital currencies, which I look at them as more of a private digital currency or a private blockchain. You also have the decentralized, which is more of an open, true P2P global. And then you have, I think it was a hybrid, but just to stick to the pure decentralized versus a more of a private blockchain decentralized currency, such as like the Chinese yuan. I think my personal view of that is actually completely antithetical to the actual reason why blockchain and crypto was created. Blockchain and crypto was created with the understanding of more inclusion, having basically transparency, so everyone who's on that blockchain can actually see what transactions and who and what is happening. Maybe it's not exactly who, it's pseudonymous as opposed to, it's not anonymous, but it's pseudonymous. If you take all the benefits of that transparency and create it and put it into a centralized blockchain like what the Chinese central bank has done, you've just given the Central Bank of China, the PBOC, even more power. They have even more data on you and what you're doing and can track what you are doing. And to me, what Facebook and their DM or Libra, I mean, these social media companies now have enough data on us. They know our digital fingerprint better than we do, and they use it to make money for themselves. For them to, if Facebook had a DM and take this whole digital fingerprint that we have to a whole nother level and control the payments around our digital fingerprint, we are going into a whole very bad world. So in my personal opinion, these centralized private blockchain digital currencies are completely antithetical as to why this entire movement came about in a more decentralized, P2P, self-sovereign type of environment.
Thank you, John. And just a comment for those who didn't know, so Libra/Diem was and is a concept of a stable coin backed by certain assets that is not an open type of cryptocurrency. So that actually very nicely leads us into our next question about surveillance and digital currency, which comes up a lot in these discussions. So does accessing digital money, does that require an identity? Does it require surveillance? Building on John's comment about the amount of data that PBOC might have if they issue a central bank digital currency, and remarks that Eswar said earlier on what routine transactions, who should know about them? If I pay my babysitter cash, do I really need to have that be digital so everybody knows where that goes? Or are there methods that can prevent that and make those kinds of transactions private? I think that these are very broad policy questions that need to be answered. So James, I know you wanted to take this question, and it's your turn.
So cash is pieces of paper. It's not surveilled. It's not at all public unless you put in effort to make it so. So you can have reporting rules that you can't have to report when you're traveling with more than $10,000 in cash. But otherwise, it's by default anonymous. And when you build a digital system that allows for payments, the default is what you architect it to be. You have to make a conscious choice about what it records and who that's made available to. And the most important property that a digital payment system will have is keeping assets conserved. That is, I couldn't go and multiply my bank balance indefinitely and take 99% of the money supply for myself. And I shouldn't be able to send the same dollar to two different people. So you have to put in consistency properties like that. And there are a range of ways to do this. If you have a single centralized ledger maintained by a single entity, which is essentially what a bank does when it keeps track of how much its depositors have put in the bank, then by default, it's tracking every transaction, who put it in, where it goes out to. If you do that at the scale of an entire country, you have essentially complete surveillance of all payments. If you then make that completely public, you have destroyed all privacy in it. If you say that only the regulator can see this and only law enforcement can, well, you've preserved privacy from my neighbors who are knowing what I'm spending my money on, but you haven't preserved it against the government. If you want to build a system that has greater privacy principles in it, then there become technical challenges around how to do that. So you're seeing a lot of experimentation right now around different models in the blockchain payment space. Some of the systems try to have very strong guarantees of privacy, and that adds a lot of architectural complexity because you have to be able to have everyone be confident that the money is being conserved and people aren't double spending their money. But you have complicated mathematical proofs that use cryptography to try to achieve that. You have some blockchains that have done things that are in between, in which you can see transactions going from one unidentified number to another unidentified number, and it takes some work to figure out who the people behind those numbers are. In some cases, you might not know at all. There's a very large possibility space of how private or how public these digital transaction systems can be, but in every case, it requires a deliberate choice about how much will be hidden and how much will be exposed, and how well we can achieve that given the engineering trade-offs.
Thank you, James. Eswar, did you want to comment?
I think it is worth thinking about the legacy that Bitcoin is leaving us, because as John correctly pointed out, the whole point of these decentralized cryptocurrencies was to get us into a world where we could have peer-to-peer transactions without necessarily relying on a trusted financial institution, including a central bank. What we might be moving towards, ironically enough, is a world where, in fact, we lose whatever vestiges of privacy we have simply because we end up with central bank digital currencies replacing cash. Now, there are potentially technological solutions to these problems, at least at some level. So if you think about China, which is experimenting with the digital versions of the yuan, they have 5 grades of digital wallets that can be used. The low-grade wallets, which can be used for very low-value transactions, give you a much greater level of at least transactional privacy, although not complete anonymity, whereas high-value transactions have to go through digital wallets that have to meet certain know-your-customer requirements and so on. So it looks like technology may at least get us part of the way towards solving the problems that technology itself is creating. But certainly there is a concern that we could be moving to a dystopian world where we lose control of our data. I do want to mention that India is approaching this in a very enlightened way, I think, creating a payment infrastructure that private innovators can build on top of. So the government essentially limits its role to setting up the payment infrastructure, does not block private sector innovation, but in addition, there is a data rail, which means that data aggregators, which will be under the government supervision, will be allowed to gather up data through different platforms, but those data aggregators will allow users to control who gets to see their data and how those data are used, because data does constitute power, and you want consumers to be able to use it. So I think we might be moving towards that sort of setup where we are going to need better protections of data, but ultimately there is a risk that, especially in authoritarian countries, we may end up with even more tools for government surveillance rather than fewer.
Thank you, Eswar. Now, this also leads into the next question, which I'm answering also some of the questions that have come up in the chat, which are really about access and inclusion. So, will digital currency be available to those without the internet? How do you have somebody who can't get a bank account because they don't have proper identity credentials today have access to digital currency tomorrow? And what can emerging markets teach us about this? So Lourdes, I know that you wanted to answer this.
Well, also very interesting the discussions, and very interesting what Eswar just said, that actually I see also digital currencies, as I said, as a way to lower the dependence on the dollar, the de facto gold standard for emerging markets, but also a reaction to the Bitcoins. As long as governments are strong, governments don't want Bitcoins. Governments will want to control the currency, as they have always done. What is a government? So one of the powers of the government is to control the monetary system. So I see it as such. In China right now, the digital currency can be used without internet right now, and I am sure similar experiments will take place in other emerging markets. But let's remember that more and more the Wi-Fi is all wireless, and the wireless is going everywhere. India is a good example where the internet connection is almost everywhere, and in Africa you have all kinds of tools to have internet in very remote areas as well. So I think this fact of not having internet connection is being improved in many emerging markets. That's one thing. And then second thing is that usually have been governments the ones that have launched these bankarization programs that, as I said, often have failed, and also these very important social programs. And actually these important social programs, in many cases and in many emerging markets, that go to the woman, go through a kind of a credit card directory. And as Eswar mentioned, in India, with this Aadhaar, this identification number goes to that. So then, as I said, don't think that emerging markets, the population is very open to new technologies, is very open to this fact because, again, the poverty is also very linked to lack of financial inclusion and also to the fact that the currency in your country has zero value. So then having zero value and going down or very little value, so then that's why also they're looking for alternatives that are becoming very so the population adjusts to the new alternatives quickly than one may have thought because of this need for improvement in their life.
Thank you, Lourdes. John, did you want to comment? I mean, in particular, when we talk about access, and we have rules about access that today mean that certain people can access these systems, what's the difference with these kinds of decentralized systems and financial inclusion?
So on the access point, I think the first point I want to make is that Bitcoin's been around since like 2009-ish. So from 2009-ish to about 2019, for about 10 years, the adoption of usage of Bitcoin was actually higher in a lot of emerging market countries than it was in the US or other countries that had stronger or existing rails. So it's not until 2020 that the developed countries have better or more adoption than the emerging countries. So from the access point of view, sure, there's a lot of unbanked and more unbanked in emerging markets, but as long as you had phone penetration, mobile penetration, you had access to digital currencies. So it is more inclusive than the traditional banking system. That's the first thing. And in the US, there's a whole new type of inclusion, in my opinion. It's what I call, and what we're seeing, and I think James will love this, it's kind of like what you see in metaverses and all of these gaming, where there's a creator economy. And even in decentralized finance, you have a creator economy because, we're at the point where, like, why do we need, well, there's reasons why we do need, but if you want to trade a stock, there's a centralized body called New York Stock Exchange. There's centralized clearing, settlement firms all behind that. There's 2 or 3 market makers. Citadel's the largest to get all these stocks traded or exchanged, if you will. But we're at the point in technology, in theory, why can't there be a system where if Susan wants to sell X shares of Apple stock and I want to buy X shares of Apple stock in a P2P economy, somehow with technology, we can just get matched up. Why do we have to pay Citadel, New York Stock Exchange, settlement providers, clearing houses, all of that in between? So it actually allows the user to be a creator. So that's even more inclusive. And we're seeing that even in gaming. Like the biggest example is, I bet you, my kids and a lot of your kids probably play Roblox. In Roblox, you can be a player there, even though that's not a blockchain or crypto company, it's got the ethos of a blockchain economy. You can be a player, but there's tools that you can create a game. And if other kids go to your storefront and play your game, you earn Robux. And there are literally kids on that make 7 figures a year of Robux. So that's also inclusion in a different way.
Thanks, John. James, I want to ask you about regulation because we have 7 minutes left, so I probably have time for 2 more questions, maybe 2 to 3. The role of regulators with regard to innovation, what should they be doing and how should they handle what's coming, which is really sort of a once in a blue moon type situation regarding technology, kind of a perfect storm?
The way I think about this is the policies we have to protect haven't changed. We need to protect the financial system from systematic threats. We need to protect people from theft and scams and fly-by-night securities fraud. And regulators should be trying to prevent those things. But that doesn't mean that the specifics should be the same. That many of these new financial systems work very differently than old ones. Not everything has to be a bank, and not every payment system is going to work the same way as interbank transfers have. So I think you want to have regulation that's goal-oriented rather than specifying rigidly the forms to which it has to happen.
Thank you. Okay, now we've had a number of questions on this. Is certainly a hot topic. Illegal activity with crypto and massive fraud schemes within these new cryptocurrencies. So what risks should we be aware of? Is this really the market, or is this just a small percentage? Is it getting a bad rap in a big name because the news can write about it? What's your take on that? John, you want to go first?
Sure. So we only have 5 minutes. I'll be brief, but if anyone wants to hear more of my opinions, follow me on Twitter, please, at John1 Woo. I think, one big case that happened this summer was the Colonial Pipeline hack, and then Bitcoin was used as ransom. And the press made a lot of hype around the fact that this is all because of crypto. And I think not enough was put on the fact that it was a traditional server that got hacked. They happened to use Bitcoin as the ransom, so therefore the press made it seem like it was a crypto problem. There was a server problem, and there was a cybersecurity problem. The ransom could have been a lot of paper bags of cash. Now the argument then is that, okay, well, Bitcoin makes it easy. But the irony for this whole thing was that the authorities, because it was done in Bitcoin, was able to actually track down who the hackers were, and the money was ultimately returned far faster than it could have been done in a paper bag of cash methodology. So my opinion is, if regulators can embrace some of this technology, and you can actually have a more secure and safer system than if you keep shunning it.
Thanks, John. All right, Lourdes, I want to go to the last question, which is, how much financial education is needed to engage with digital monies? And should it be the guys who are creating the protocols responsible for teaching it? Should it be in schools? Should it be separate classes? How do we get this? Because it's clearly a new system. How do we get at this issue?
Okay, so we are talking about two different things: central bank digital currencies and bitcoins. Bitcoins, and again, going back to the initial reaction of people in El Salvador, is more complex. Digital currencies is basically doing more, instead of with a credit card, with a mobile payment, QR codes, that is already being done in many countries. E-commerce platforms in Africa, Jumia has adopted Jumia Pay, Mercado Libre Latin America has adopted Mercado Pago, and of course Alipay in China and WeChat Pay. So mobile payments are very much part of the thing in emerging markets, much more, as you were saying, than in the US. So regarding that, I see to a central bank digital currency, I see quite a smooth transition in emerging markets. Bitcoin is another matter because it's more complex, it's less transparency how it works, and as I said, it was an initial reaction against to be used as legal tender, which is definitely a very important step, and also it seems that Cuba, Panama, and other countries are going to use it as well. So I think it's two different things.
Thank you. Okay, we don't have very much time, so what I want to do is each of you give me one sentence. What does the future hold for money? Eswar.
So we started with my book, and we will end with the title of the last chapter of my book, A Glorious Future Beckons, Perhaps.
Thank you. James?
It's going to be digital. I don't know how, but it is.
John?
In 5-10 years, we won't be having this conference call because it's just going to be there.
Lourdes?
I agree. Let's go for central bank digital currencies, which will be very important very soon.
Thank you. So I want to thank our panelists for a really outstanding discussion, and I want to thank our audience for really insightful questions. I'm sorry we didn't get to all of them, but I hope that we were able to answer a lot. I will, of course, plug Cornell, which is on the forefront of the future of money, from finance to legal to tech to entrepreneurship. And I think that we are really in a very exciting time. You only need to look at the headlines to see that. So I encourage you all to learn more about it. And I also encourage you, my other plug would be to check out the FinTech at Cornell initiative at the Johnson School and contact me with any questions. Thank you.